Hey, good morning, everybody. How y'all doing? We are into it. Second day, and it seems like we're still spinning our wheels looking for a narrative. We have a lot of conferences coming up over the next 2 weeks, and we have some big earnings coming too. Got the State of the Union tonight. That's going to be hitting. So there's still a lot going on. Bricks that continue to pile up in the wall of worry. And this rotation of capital is still not turning back to the normal, I don't know what you want to call it, the normal parking spots, I guess. It's just money continues to rotate, and we're not seeing it go where it normally would be. So, keep our eye on that. The good thing is we'll know it when we see it. It very likely won't be subtle. So we just have to ride out the storm. You see, Japan is up 0.5%, and looking at things on the other side, the UK is down just just below zero. Hong Kong basically flat. S&P closer to the Russell in activity this morning than the Nasdaq. Then we have the Dow up a quarter, and the Nasdaq doing most of the heavy lifting. This is not some solution, right? We're not seeing that sort of push yet, but having things only up a little bit does offer opportunity. I'd rather have that than seeing us up, 3% in the morning. That doesn't really leave us much room. Looking at what we've got on the economic calendar for today, the bigger risks seem to be the conferences and the events and the speaking engagements rather than what we have on the economic calendar. Wholesale inventories, the numbers aren't even suggesting a change there. Consumer confidence, that's more of a warm, fuzzy feeling and a survey and questionnaire. So it's not what we're looking for, right? Looking for solid numbers, significant changes, something that can catch the market offside, force them to participate. We don't have anything like that today. It's not to say that there isn't areas of risk. We can see we've got the Bank of England, Bailey speaking today, and Green, Pill, Taylor. Then we've got in the U.S. Fed, Waller and Cook. So we've just got a lot, right? Barkin, Collins, all day long. But really, what are they going to say? They're just talking out the side of their neck, chipping teeth on the same old stuff, singing out of the hymn book, not expecting any new, right? There's not Revelation Day or anything like that. There was some news in the Mag 7 front. You can see this Meta headline, AMD. There's some NVIDIA headlines. So money's moving. The opportunities are coming in. We just got to see what the market's going to do with it. Too much uncertainty at the moment. Right? The lack of forward guidance continues to be one of the largest issues with the forward outlook. So you can always go to the Fed Watch, see what the market is anticipating, how they're pricing in forward guidance or the lack of forward guidance. We're looking for significant changes to the existing structure. So if they're coming in to unwind an anticipated rate cut, or if they're coming in to price in a rate cut, we should see it. If the numbers are just slightly shifting 1 or 2 points, that's not what we're looking for, right? That's just waves. It's not really a big deal. Still, you want to continue to look at this, especially after we do get headlines, to see if any new information that we're getting is changing the market's perception of the potential for cuts. All right, that pretty much just says it all right there. The State of the Union tonight, but it is tonight, right? It won't be during the trading day. The problem is when we have something such high risk looking at us on the same day, the markets are very likely going to start to chop and to go sideways into the event, right? That isn't always the outcome, but it certainly is the outcome often enough that it's what we begin to anticipate. So the base case for today is that nobody's going to want to get heavily positioned in front of what could be a high volatility event. And that should make sense, right? If we consider what the high volatility event could be, something like a big earnings or CPI, PPI, non-farm payrolls, when you know that there's a really large binary event coming at you, the best thing to do would be to pull over, take your hands off the wheel, right? Just put it in park, try to get the hell out of the way. Why guess or assume that you know the outcome of what's going to happen, right? That we go up a lot, we go down a lot. So that's what we anticipate is a lack of participation, a lot of hedging activity, something like that. It is going to be for tonight. So seeing that sort of activity this early in the morning, probably not going to see a lot of it. We're going to look because, I mean, if it was there and we didn't look, I guarantee we wouldn't find it, right? So we are going to look, but we're not expecting to actually find anything this early in the day. But that's what you want to continue to look for throughout the day. When are they going to start to come in and begin to hedge? And when are they going to build the structures that are designed to protect them as we get closer to the end of the day? What comes out of this is likely to affect the rest of the week. It's possible, right? It doesn't have to, but we don't know what we don't know. So we just need to get through it, see how the market reacts to it, see how bad it gets, and then we'll just go from there. So one of the key things to all of this is know what you own. Take a good long look at what you're holding in your portfolio now and ask if you would still like it if the entire market went up 5% or down 5%. If you don't like what that would look like, then you really need to readjust what you're holding or how you're holding it. Because that's what's on the table at the moment, right? We could get some very large moves. And again, I'm not saying we're going to get large moves. But in this situation, you damn sure should be prepared for it. Overnight trading at 78,000. The average is in the mid 50s, so we've got really good participation. They're not sitting out. We are still inside of yesterday's range, and all things considered, we're in the lower half of that range. So this is all of yesterday. If we was to split that in half, we can see the midpoint is around 68.82, and we're underneath that midpoint. We haven't even had the push to touch that midpoint. Certainly haven't been able to get through it and get above it. We're below the zero gamma, but as I've mentioned before, that doesn't put us in the dealer regime where we expect them to sell into selling or buy into buying, because we're at zero gamma. As long as we're crossing back and forth through this zone, we won't see those negative gamma dynamics. We would have to get far enough away from it that it cements our positioning and then see them begin to hedge to remain delta neutral and sell into selling or buy into buying. We're not there yet. If we get below, say, yesterday's low, maybe challenge that put wall, then certainly we could see them exacerbate the situation and push the markets in whatever direction the market is moving. So keep our eye on that. Looking at what is over our head, we got the 10-day, the 10-week, the 20-day, the 3-day, the 3-week, everything is piled up over our head. And if we just step over here to the daily for the minute, we can see the midpoint of this drawdown here from this low at 67.50 all the way up to 70.50. The midpoint here, we're under that mid. As we were talking about yesterday, just being underneath that mid puts us in a more negative light. It doesn't mean we have to go down. I certainly wouldn't load up on a bunch of puts, but if I was looking for the health of the way things are right now, this is negative to be under that midpoint. The range continues. We've been running it for days. It looks like right now we're testing an opportunity to get back outside of that candle. This is IX10, right? Inside day breakout that lasts for more than one day. And we are right at the moment trying to break out of that. But we did that before. And we did it before over here, even here. So wicking outside doesn't mean anything. Closing outside of it and continuing to move further away from the range, that would matter. But otherwise, we're still just carrying on as we have been carrying on. If we look at the moving averages for a moment, this isn't about moving average bounces and moving average crossovers. That's not really my style, right? But we don't want to ignore them. They are offering you insight into market structure. And as you can see, they're aiming lower, right? They're not flat and even. They're not pointed higher. They are pointed lower. Collectively, the average of price is descending, right? That's pretty Captain Obvious. But when we think about the range is beginning to fade to the downside, like a slow grind. Step out a little bit, widen our point of view, we might be in the lower part of that range that we were looking at. But when we zoom out into this larger range that we've been in since November of last year, you can see we're still holding above 6,800, and that's the upper part of this range. As long as we're still inside of that, then the primary trend is still more bullish than bearish. The secondary trend is bearish. You could display that same logic with something like a MACD, right? The MACD is read the same way, primary, secondary, then whether or not we're bullish or bearish or sideways. So it's the same kind of logic. All of this is pointing to weakness and pause, but not a breakdown, right? If they were selling off significantly and dumping the system, it would not be subtle. We would see it. We're not getting that. We're just not getting anywhere. And there's so much money moving around these markets. But it's not going into the normal markets that we would expect money to flow to. That messes with the various tools that are out there and the different ratio charts that we use. Since we've been tech centric for so long, benchmarking things against the Qs or using Mag 7 and Top T type ETFs that highlight what money generally does is just missing what's going on at the moment. That might feel bearish when some of the biggest names that we're used to trading are flat and or going down, but the broader market is not in that boat. In fact, I was looking at some of the charts that I run and just, asking that question, where's money going? And if you look at some of these ratios, okay, well, that's gold. We all know what gold did. That's not much of a surprise. The total world market and or just emerging markets, which is not U.S. classified, right? We don't fit into that box for emerging markets. International markets. So the money's out there, and sure, at the moment, everything has kind of turned over. We're getting that little crimp at the top of that run, but look at the run itself. That's emerging markets. So if everything was negative, we would not have that sort of slope, right? It's kind of the long and the short of it. Everything would be flipped over. It would be more negative like this. That's what we were looking at as the president was ramping up into that tariff talk from 2024 into 2025 and then into the April lows before the bond vigilantes bent him over a barrel. So that is what negative would look like. We're not in that sort of regime. So I don't want to make it sound like we should be bearish and just loading up with a bunch of puts. It doesn't hurt to have some hedges on or even some trades to the downside because there are short opportunities. But there's no signal that the market is just heavily negative and that we should short the broader market because we don't have that yet. All right, looking at the ADR for today, we are really going nowhere. Nice tight range to start everything off. My concern is that it's going to look like this all day. One, that would be really rare. Um, we haven't done that in 6 months or more. It's been quite a while. And while it does happen, it's a very rare thing to have such a compressed and narrow range like this that lasts all day. So the likelihood that we do that is very, very low. But if we take that as a part of the bigger picture, which allows us to widen the range out just a little bit more, we could sit in this for the rest of the day. We already have sat through it for more than half of a day. So we would just be continuing on from what we started yesterday. While this range is a little bit bigger, it's still a very compressed range. These are the kind of ranges that we used to have before COVID hit, back in the day when our average daily range was less than 50 points a day. Right? I think it was in the 40s back then. So as you can imagine, back then we didn't get very far on a day-to-day basis. It's still unlikely that we spend the whole day inside of this narrow range, but I really want to prepare people for the idea that we could. So on the one hand, it is no different than any other day on the idea that we got to get the hell out of the box before we do anything else. And on the other hand, we got to temper our expectations on any idea that we could easily get back to, say, yesterday's high. At the moment, getting back to yesterday's high would be a significant thing to accomplish. So if we can get this breakout above our Globex high, get through the mid, challenge the RTH open, which is the ADR half, get through all of that, then we can challenge the high of yesterday and maybe get that push into 69.50 and then up into the full ADR. It's possible. The path of least resistance, however, is to fade down, break yesterday's low, and expand to the outside 6811 cog line, get to this lower ADR half. And it is very likely we stay within our ADR all day. So even if we do get outside of this first box, it's unlikely that we get outside of these two lines. We might wick out of it, but I wouldn't expect to get out and continue to keep it, not unless something changes, right? Some headline that we don't have at the moment, some flows that could come in after the open. Like, things can change, but with what we have right now, there's no reason to anticipate getting outside of that range. And it's 100 points, right? 69.08, 68.08, because our ADR is 100 points. 100-point range on the day is not unreasonable at all. What a cluttered mess. All right, today's floor pivot is lower than yesterday's floor pivot. That's bearish. Price opened underneath that floor pivot. That is also bearish. We've already tagged that floor pivot, so we don't have any reason to think we're going to go up just to get that done. We wasn't able to get through it and keep it, and now we're driving farther away from it. All of that is bearish. When we think about the move to the downside, we want to consider the SNR levels. Since we've had these narrow range days, the SNR levels are a little closer than they typically are. Here's S1, 68.17. If we can get an inside day breakout into the 111 or the 1236, then that would be a nice reversal point. So here's 111 and the 1236. We can see that all we got to do is get down into that 111, overshoot it just a little bit, and we would be into S1. Nice place for a reversal and to come right back out and flip it to the upside. We are underneath the weekly pivot. It's worth mentioning, when we're under that weekly pivot, we're in a bearish posture simply because of that, right? And that doesn't mean we have to go down. It just, broadly speaking, means that we're in a weaker environment. We didn't get much, so there's not a lot here yet. We challenged that large footprint last week that we developed last week. We challenged it yesterday right there. Wasn't able to keep it or sustain it. Couldn't even get all the way through it and close above it. Ended up giving that away. We cut through the value area low of last week like it wasn't even there. Got back above it, but we just testing it again now, challenging it. Not getting a lot of help from that structure. It does thin out once we're outside of that value area low. So if there's anything down here that we're hitting that's helping us, it's not coming from this footprint, right? And that's really what we want to acknowledge, is that if the footprint is helping us out, then great, we'll take it. But if it's not, then, we just continue to look for whatever else is out there that might be assisting us at these lows. We got the COG line 68.32, but that alone isn't enough. All right, we continue to dwindle this footprint that's over our head. As we talked about yesterday, as long as we don't break last week's high and drive back up there, then the entire 10-day map should narrow in quite a bit. 69.32 COG line is that line in the sand to the upside that we want to stay underneath if we want to narrow this map up. Otherwise, if we break back above 69.32, we'll put in some new prints up here, and then we won't see this thing narrow in. The other problem is if we break the low 67.92 COG line and start expanding to the downside, then we would be looking for the whole footprint to shift and for it to look more like that. we would be firmly underneath the point of control for the 10-day and have that significant footprint over our head as a resistance level that we would have to work through. The VPOC that we developed on Friday, we took out yesterday, so we're done with that. We did have a new VPOC this morning, but we just took that out. Now, the textbooks are going to tell you to carry this line forward every day, whether it's been hit or not. I generally don't do that, right? Just unless I've got a reason to, I only carry it forward if it has not been hit. But there are times where it's worth keeping it on your radar for the day. This is no longer a VPOC. It's why I changed it. It's just a regular POC line. I would keep this line on your radar for the day. You don't really need it because it's already at an options level 68.50. But if you wanted to stack up and add your ands together, then that would be another one, right? If you haven't heard the phrase before, adding your ands, if you can look at a particular level, say yesterday's high, yesterday's low, but then you can add more to it. So say it's yesterday's high and it's R1 and it's the ADR half and it's the 10 period moving average and it's the weekly 10 period average. So you add your ands to it. If you had all of that over your head at yesterday's high, then A, if we start moving in that direction, it's likely we would gravitate to it, and B, it would be very hard to break through that level, right? Just stacking up your ands. So keep 68.50 on the radar from that VPOC level. We're done with it from a point of control as a level that hasn't been touched, but we're not done with it as a point of control from that was the greatest amount of trading activity yesterday, and it's likely we'll see more of that in the RTH session. I mean, yeah, we're hitting it now. You should see it on the tape. You should see the behavior within the dome or the active trader, but I would be interested to see what the tape looks like past 9:30 if we happen to interact with that level again. Looking at the weekly expected move, we're still holding out well, haven't tagged the lower edge, which is 67.86. So it's there. At the moment, all things considered, we're not doing too bad at this point on the week. A decent expansion. It didn't get us too far, which is kind of the point. Barely outside of Friday's range and Thursday's range to the downside. We've already come back in again. So we're not seeing price move too far, too fast. We're not oversold. We're not overextended. It doesn't owe us any sort of mean reversion or pullback, least squared methods, dot plot statistics. Nothing says that it owes us a move back in the other direction yet, which is kind of the idea, right? The whole point of keeping track of how far away we are from the tens is that very question. Have we moved too far, too fast? And does it owe us a move back in the other direction? Nope. Looking at the 10-day, we are beyond my imaginary collar of 0.5%, but we're still within the 1% collar, which means even though we're under the 10 and it's a little negative, we're not in danger at this point. This isn't, it's not unhealthy. It's not healthy, but it's not unhealthy. And at the moment, everything is fine. So I want to just give it the time that it needs, keep track of it, make sure we don't expand too far. Getting below, say, 1% or even into 1.5%, that would get us into a, quote, too far area. Getting some headlines on Novo Nordisk again. See if that calms it down a little bit. All right, and for the 10 week, we're right back to a 0.5% underneath the 10. We haven't even gotten to a -1%. And so we're basically just still sitting near the center of the court. We haven't done anything, we haven't gone anywhere, but we're fully charged. We have a lot of fuel, a lot of energy, and we're ready to go. All we need is the spark, the catalyst, the light to turn green, and we can get this thing going. Looking at what's down this morning, we've got China, Bitcoin, gold miners, all down. Uranium, nat gas. So uranium, a little low on the list. Uranium's down slightly, but not enough. Our benchmark is a 0.5%. So you can see the Mag 7 up volume is down. China, nat gas, China again, gold miners, junior miners, Bitcoin. If we was looking for a rally day, we would want those Mag 7 and we'd want Bitcoin. Bitcoin is a nice risk signal, right? If they're not willing to take risk, then looking for long opportunities, it gets to be pretty slim. But on the other hand, for our long opportunities, we got chips up, and chips are good. Chips are a very good signal for a bullish day, but they can't do it by themselves. So we need that rising tide. Behind chips, we'd want the broader Mag 7 group, the top 20 next. Behind that, it would be good to see it spread out like a rising tide lifting all boats. So financials, consumer discretionary, start getting into industrials, building materials, and really just, spread out across the market. We don't have any of that. All we've got is chips and the VIX. Now we can get spot up, vol up. Having the VIX up is a good start. Keep your eye on that dichotomy because it's certainly a possibility on a day like this. Generically speaking, we've got generic tech XLK. So adding that with emerging markets and chips, it's a little bit in the right direction. It's just not enough. The one good thing about a morning that starts like this, when you have a lack of something, is that should something come in, you won't miss it because you went from having nothing to having something. That might sound a little weird, but if you come across one of those mornings where everything out there is up, say a 0.5% or 0.75%, now you're already starting with something and you're trying to gauge how much more of that something are you going to get and is it going to be enough to move markets. So that's a lot muddier than the situation we have where we basically don't have anything. And if you go from nothing to something, it's easier to spot. So at the moment, we're in a hurry up and wait mode, and it's very likely that this is going to extend through the whole darn day. If that's right, we're going to have a very boring day while we wait for the big State of the Union address tonight. So I hope I'm wrong, but it's very likely that we stay inside of this box, other than maybe wicking outside of it, that this becomes our entire trading day. That is going to be a very boring day. So, shop around, find something else to trade. There's always another product, right? Copper is a good one to trade, gold. Um, even look at one of the other indexes. Although, to be fair, if the S&P is sideways, then the others are probably going to be sideways too. But there's always something, right? So don't feel like you have to just lean into that same thing that you trade every day. There's always something out there to trade. Or just, you know, sit out, maybe read a book, learn something new. So as usual, get outside the box. We've already got the levels established. All we got to do is break out and get them going. Up or down, there's no bias in this at this point. Just we got to get out of the box and get it going. Simple, easy, watch the clock today, right? If we're going to get a breakout, it's going to be on headlines. It's going to be on some sort of news. So keep your eye on the clock. Look for that dynamic to change. Be careful, be safe. I'll see y'all tomorrow.